Everybody needs to plan for his retirement, and the biggest thing that everybody has to prepare for is that how to invest so that you don't outlive your investments. This is a phase when you are most vulnerable, you are less confident, you are scared, and psychologically you are unsure because your income has stopped now. So it is important to build a solid plan which never fails.
Hello and welcome to Investors Hangout. This weekly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, when it comes to investing, for a lot of us, the most important goal is to save enough for our retirement, because the end of work doesn't really mean that the bills will stop coming in. So, how to generate a regular income in retirement? We'll talk about that in today's episode. Stay tuned.
Do I have enough to retire is a very subjective question. It is, and it can't be, it can't be one amount fits all. It entirely depends on what is your scale of expenditure, or also what is the likely changes in your, the configuration of your expense. But before that, you should see that, do you have some outstanding debt? Should you become debt free? More so on the eve of your retirement, because I think that is the important step to take. And then you can cleanly look forward to your retirement planning or retirement investment planning, so to say. If you're retiring now, then you have a far better, more realistic estimate of what your monthly expenses are, and multiply it with 12, and that's the return expectation, or that is the minimum return expectation that should be from your investments, adjusted for any income that you may have. So that is a very basic thing. The most complicated dimension of your retirement is that nobody knows how long you are going to live. So you have to prepare yourself in a manner that if you live forever, you should not outlive your investments. You should not outlive your savings. So, and how do you do that? You have to plan it in a manner that you are able to consume. It is able to support you meaningfully on a continuous basis, and invested in a manner that has the possibility of you don't run out of money. These are very complicated dimensions of retirement investment planning. But if you do these 2-3 things, one is that your annual expenses, and if you have 20 to 25 times of that in current value terms, looks like it'll be okay. It'll not be very comfortable, but it'll be reasonable to support you with income. There can be an investment plan which can be, if you have 25 times or 20 times your annual expenses today, then there could be an investment plan which can be done in a manner that it will not only support you with income, but it can be invested in a manner that it is able to grow as well, besides giving you income. But before that, get rid of your debt. Clear up any contingency that might come your way, or any outstanding big expenditure that you would have planned for, and it can happen. So all those things needs to be carefully planned. It's essential to invest simply because you need more in future. If you have any amount of money, and if you are taking 5% of that money every year, and that is divided over the next 12 months, or divided it into monthly withdrawals, that is fine for now. That might be fine for even next year, but will it be good enough 10 years from now? The same amount of money would have lost money, and you lost its value, and you will need much more 5 years from now, 10 years from now, simply because of inflation. And in that case, if you invest entirely in fixed income, which most people think that in retirement they have to be completely risk averse, it will not be good enough. It will not be enough to support you, because you don't have to necessarily just plan for today's income. You have to make sure that you have future larger income requirement, and invest in a manner that your investment will be able to support that. And there is no other way but investing in equity. Now, one will say that, this is the phase of life when people get very risk averse, why they should take the risk of equity. I would like to clarify here that, volatility is not risk. When you invest in equity, it is very risky. but so is electricity, but we live with it. And that is why you have to configure yourself to live with it. To be careful with equity means building your position in equity over a period of time, not investing in one at one go, diversifying your portfolio, and periodic rebalancing. And in your income portfolio, because you have to necessarily withdraw, that rebalancing can well be very well calibrated depending on your income from equity or debt, depending on what has gone up more. Deciding asset allocation is a function of your comfort, how upset you get when the market goes down, or how comfortable or how used to you are. If you are starting today, if you have never made a market linked investment, then you have to start conservatively. Even if you are temperamentally you are venturesome, but still I would say that most venturesome investors, most supposedly brave investors, when they are faced with the reality of the steep market decline in a brief period of time, it's very scary. And it's more scary when you are when you are take retirement. Even if you have requirement for larger income, higher income, it should be a minority part of your investment. Minority meaning 1/4 or 1/3, and write it on a piece of paper, and then for the first 2, 3, 4 years, you should be rebalancing it to that, resetting that allocation every year, so that you develop a belief in this, and at the same time also able to ride the growth of equity. If you are if you are a confident investor, you are experienced, and you also have some margin in terms that 3.5% or 4% of income from your capital today will be enough to support with your income, then I would say that you're a comfortable investor. And those investors, I think, to keep it simple, it should be equally into equity and fixed income. When I'm referring to equity allocation, I'm referring to in your retirement, the preferred vehicle. I'm talking to all your investment, which means it will also have senior citizen savings scheme, all the accumulation that you may have in public provident fund, and because they are the safest and highest yielding fixed income alternatives. Take them holistically and have 5 to 10%, 15%, 20% in short-term debt fund. That will be the balancing fixed income allocation. You will have all the flexibility with these. Those are, senior citizen savings scheme and PPF will be the money stuck. But the income that you derive from them will be either tax-free income or the highest possible income from senior citizen savings scheme. 10-15% into short-term debt fund will be your rebalancing allocation. If fixed income becomes more than 50%, you will reduce your allocation there. If it becomes substantially less, then you will move your money from equity into those short-term debt. There are investors who invest in retirement and they don't have dependence on their investment for income. And if you get some periodic income, that'll be fine. But you would ideally like to grow your money well, and so that you can leave a larger estate. If you are that kind of investor, then invest 25%, a fourth of your money or a third of your money into fixed income. Have substantial part into equity. The advantage of this will be that you will still have the reallocation, rebalancing allocation to fixed income, and you'll be able to sell high, buy low in a meaningful manner, and you will leave a much larger estate simply because you have the liberty. You don't depend on that income. The retirement investment action plan should be first and foremost, get rid of your debt. Consolidate all your investment, at least if not consolidate into your bank account. Make a list of everything, what all is invested where, and choose one allocation. Whether you want to be 50% into equity, whether you want to be 25% into equity, or whether you want to be 25% into fixed income. Do your estimation of your expenses today. If you retire today, how much do you need every month? Multiply it with 12 and see that how much does it translate into. And also consider what will be your income from any source. Will you get any pension? Will you have some rental income? Will you have some remittance from some children coming your way very regularly? If you have any of those things, total it up. Look at your income, look at your expenses, and the difference has to be supported by your investment. If there is no difference, if your current income is more than what you spend today, then you are a very lucky retiree, assuming that you have a crore of rupees, and your income requirement, which needs to be supported by this investment, is more than 5 lakh rupees a year. Then you need to really articulate, you need to be really careful about your investments here. And this needs to be invested in a manner that it keeps growing and you are able to withdraw, you are able to derive some income out of it at defined periodicity without the risk of eating into your capital. And for this, the simple plan should be choose your allocation, invest through diversified vehicles. In your fixed income allocation, retain your senior citizen savings scheme and PPF accumulation, because they are the safest and high yielding options for Indian investors, and it's quite a privilege to have that. And do an annual rebalancing. Every year, take a look on 1st of April. How much of your money is grown in equity, how much of it is in debt, total it up, whether it has moved from 50% into equity or debt, and then make that change accordingly. We did this illustration for you. If you would have invested 50 lakh rupees in 2013, and I'm just going backward and investing in equity and fixed income equally. So assuming that your need for income was 6%, you could take out 3 lakh rupees every year. So the result of this illustration from that diversified portfolio of equity and debt is that first year you took out 3 lakh rupees, which was 6%. Next year, you could have taken 3,08,000 rupees. The market did not go up very substantially after you took your 3 lakh rupees. The next year after that, in 2015, it got revised upwardly to 3,51,000 rupees per annum. So as a result of this, in 2023, your income every year has grown to 4,32,000 rupees, which is 6% of the enhanced capital of 72 lakh rupees. You started with 50 lakh rupees, it has grown to 72 lakh rupees. And 6% withdrawal of that 72,000 rupees is 4,32,000, which has definitely grown much more than inflation. And your investment is very much in a position to support higher income requirement even in future. And with this plan, you are very unlikely to outlive your investments.
Well, that's all we have for you in today's episode. Keep watching this space for more information. If you like the show, do subscribe to our YouTube channel. Take care. Bye for now.